Welcome to the VHCOL Financial Paradox, where the biggest mistake many ambitious buyers make is sacrificing future home equity by overpaying low-interest debt today in very high cost-of-living markets. Aggressively paying off a 4.4% student loan can feel responsible, but it often pushes your homeownership timeline further away. Instead, the smarter move is usually to prioritize saving for a down payment, because opportunity cost and home price appreciation can outpace your debt's interest. Throughout this video, we will unpack the math, the trade-offs, and a practical plan you can follow. To keep things moving, we will compare strategies, walk through a numbers example, and discuss exceptions and risk management. Now, let's start by laying out the roadmap so you always know what's coming next. First, we will define the dilemma and explain why low-rate debt is different from high-rate debt. Next, we will show how opportunity cost and home price appreciation dominate your results in VHCOL areas. Then, we will give you a step-by-step plan to prioritize your down payment. After that, we will cover risks and exceptions, because no strategy fits everyone. Finally, we will test your knowledge with quick quizzes and summarize key takeaways. With that in mind, let's dig into the paradox itself. Here's the dilemma. You have a 4.4% student loan and a strong desire to be debt-free. Yet, in very high cost-of-living markets, homes can appreciate at rates that outpace your loan's cost. Meanwhile, today's secure savings options, such as high-yield savings accounts and short-duration treasuries, can often equal or exceed your loan rate. This means that every extra dollar you send to low-rate debt may carry a large opportunity cost. Instead of getting closer to buying a home, you might be delaying it as prices rise and the down payment requirement grows. Consequently, reframing that debt as cheap financing and prioritizing cash accumulation can be the superior wealth move. Now that the paradox is clear, let's examine why overpaying low-interest debt often backfires in practice. When your loan is around 4 to 5%, that debt is considered cheap capital. If you can earn comparable or better returns in secure savings instruments, then every extra dollar sent to the loan is a dollar not working for your down payment. In VHCOL areas, appreciation can be rapid, and the required down payment can increase faster than you can eliminate low-rate debt. By focusing on minimum payments and channeling surplus cash into high-yield savings or short-duration treasuries, you preserve flexibility and accelerate your path to the down payment threshold. The compounding effect on your savings and the rising price of the target property together make time your most expensive constraint. With the logic in place, let's visualize a decision flow you can follow. This flowchart starts by checking whether your debt rate is at or below approximately 5%. If it is, and if high-yield savings or short-duration treasuries yield roughly the same or more than the debt, then the recommended path is to pay the minimum on the loan, build a 3 to 6 month emergency fund, and then direct all additional cash to your down payment fund. Once you hit your target loan-to-value threshold and close on a home, you can revisit the pace of debt payoff. If your savings yield is below the loan rate, the flowchart suggests a split approach where you add a modest extra payment toward the debt while still saving. Finally, if your debt rate exceeds about 5%, the chart recommends prioritizing faster debt reduction while maintaining a minimal emergency buffer. Next, let's run a numbers example to show the trade-offs over a 2-year window. Assumptions for illustration. Starting target home price is $1 million, appreciating at roughly 6% per year for 2 years, adding about $126,000 to the price. A 20% down payment therefore grows from $200,000 to about $225,200. The student loan is at 4.4%, with a minimum payment made in both scenarios. In the crush debt scenario, an additional $1,000 per month is sent to the loan for 24 months, reducing principal by roughly $22,800 compared to paying the minimum. However, cash reserves remain low. In the stack cash scenario, that same $1,000 per month is saved in a 5% yield account, compounding to about $25,180 over 24 months. The home's appreciation occurs in both cases, but only the saver builds liquidity to meet the higher down payment requirement. Therefore, the cash-first approach typically moves you closer to a timely purchase in a VHCOL market. Now, let's sanity check the math with a quick markdown breakdown. This quick check shows how the monthly contribution grows at a 5% annual yield. The future value formula demonstrates that $1,000 per month compounds to roughly $25,180 in 2 years. From an opportunity cost perspective, when loan rates and safe yields are similar, Extra payments to debt simply displace dollars that could be earning toward your down payment. In very high-cost markets, where appreciation can be meaningful, the difference in interest versus yield is usually smaller than the effect of home price changes on your down payment target. As a practical rule, when your loan rate is at or below about 5% and safe yields are comparable, prioritize building liquidity first, then reassess accelerating debt after you close. Next, let's talk about risk management and exceptions. Risk management comes first. Ensure you have a 3 to 6 month emergency fund before maximizing down payment contributions. If your loan's APR materially exceeds what you can earn safely, you may tilt more toward debt reduction. Market risk also exists. Prices can stall or decline, although the long-run trajectory in VHCOL areas has historically been upward. Psychological factors matter too. If small extra payments help you stay engaged, that's fine. But do not let them compromise the speed of your down payment accumulation. Finally, prioritize liquidity over illiquid investments before buying, because you will need immediate access to your funds for closing costs and reserves. With risks covered, let's compare the two strategies side by side. On the left, crushing debt produces faster principal reduction and lowers interest costs sooner. It can also provide psychological relief. However, it slows your liquidity growth and can leave you chasing an appreciating market. On the right, stacking cash maximizes liquidity for your down payment and maintains flexibility. With safe yields potentially matching or beating a loan around 4.5%, the opportunity cost of prepaying is high. This approach also aligns better with markets where appreciation can outpace debt costs. After closing, you can always accelerate debt repayment if your cash flow allows. Now, let's turn this into a concrete plan you can execute. Start by auditing your loans and the current yields available in high-yield savings and short-term treasuries. Next, build a 3 to 6 month emergency fund. If your low-rate debt is around 5% or less and yields are similar, make minimum payments on that debt. Then, automate contributions to a dedicated down payment account on a frequent cadence to build momentum. Define a target loan-to-value ratio and price range, and track appreciation in your specific VHCOL area. Continue funding essential retirement accounts, especially any employer match, while directing the remainder to your down payment. Reassess quarterly because rates, yields, and your income can change. Once you reach the required down payment, plus closing costs and reserves, begin shopping in earnest. After you close, reevaluate whether to accelerate debt payoff using your improved cash flow. Next, let's see what you've learned with a quick quiz. Question: if your student loan APR is 4.4% and your high-yield savings or treasury yield is 5% in a very high cost of living area, which approach is typically superior for rapid homeownership? Option A: aggressively prepay the loan to be debt-free as soon as possible. Option B: pay the minimum on the loan and stack cash for the down payment. Option C: split evenly with 50% extra to debt and 50% to savings regardless of market dynamics. Option D: stop all debt payments and invest everything. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to pay the minimum on the loan and stack cash for the down payment. Because your safe yield is equal to or above your loan rate, the opportunity cost of prepaying is high. In a VHCOL market, faster liquidity growth typically improves your ability to buy sooner and participate in home appreciation earlier. Next, let's try a second question focused on risk. Question: what is the biggest risk of delaying home buying to achieve debt-free status first in a very high cost of living market? Option A: missing out on potential property appreciation and a rising down payment threshold. Option B: losing your credit score completely. Option C: breaking loan covenants immediately. Option D: paying taxes on high-yield savings account interest. You may pause the video now to think about the answer. You'll discuss the answer in the next section of the video. The correct answer is missing out on potential property appreciation and a rising down payment threshold. In very high-cost markets, prices can increase quickly enough that your required down payment grows faster than you can eliminate low-rate debt, pushing the goal of ownership further away. Now that you understand the trade-offs and risks, let's include an explicit disclaimer. This content is for educational purposes only and does not constitute financial advice. You should consult a licensed professional for guidance tailored to your circumstances. Market conditions, interest rates, and yields change, and the right approach depends on your risk tolerance, job stability, and liquidity needs. With the disclaimer in place, let's reinforce the key ideas to remember. Remember these points. Low-rate debt is cheap financing, not an emergency. In very high-cost markets, time and appreciation often outweigh small interest savings from prepaying. Build liquidity first through an emergency fund and then a focused down payment account. And only after closing consider accelerating debt payoff. Always match your strategy to the spread between your debt rate and safe yields and to your own risk profile. Finally, automate your savings, track your target loan-to-value, and reassess quarterly. To close things out, let's summarize and send you off with next steps. In summary, aggressively paying down a 4% loan may feel responsible, but in a very high cost of living area, the opportunity cost is often too high. With safe yields capable of matching or exceeding that loan rate, and with home prices potentially appreciating faster than your debt accrues interest, prioritizing down payment savings typically moves you toward ownership sooner. Build an emergency fund, automate contributions, track your market, and buy when you hit your target. After closing, you can adjust and accelerate debt payoff from a position of strength. Finally, here's a quick thank you and a small ask. Thank you for watching. If this was helpful, please like the video, share it with someone who is saving for a home in a very high-cost area, and subscribe for more practical financial strategy. Tell us your city and your biggest hurdle in the comments so we can tailor future videos to help you win.